Fusion Mobile, quality e-learning experience on the go.
Documents in buying and selling goods. Commercial documents are official papers which facilitate the act of buying and selling goods. All business transactions must be backed by relevant documents in order to show authenticity as well as for record purposes. The various types of commercial documents currently in use are as follows: the trade journal, the letter of inquiry, the catalog and price list, the quotation, the order, the invoice, the delivery note, the consignment note, the credit note, the debit note, the statement of account, the pro forma invoice, the receipt. The trade journal. The trade journals are publications which serve as sources of information to the buyer, as it contains articles on matters of interest to people in a particular trade. Trade journals contain information about price, terms of payment, terms of sales and delivery. The description of the goods will also be shown on the journal. Letter of inquiry. Letter of inquiry is written by the buyer to the producer or supplier asking for information about certain goods which are for sale. The letter will inquire about the terms of sale, payment, delivery, and other relevant information before the buyer decides on one particular producer and what to buy. The prospective buyer may request for the price list of the goods. Uses of letter of inquiry. Letter of inquiry is sent by the buyer to the seller to find out about the availability of goods, their prices, and the terms of payment. It informs the seller of the goods required, the quantity, the time, and the terms of delivery. The catalog and price list. The catalog and price list is a pictorial presentation of goods and articles available for sale, especially in mail order business. It is a medium of advertising. A catalog is used to inform the buyers of the details of the goods as to size, colors, prices, and delivery terms. A catalog can also be used as a quotation or reply to inquiry. The quotation. Quotation is a statement prepared by a supplier of goods or services for a particular order which shows the current price and terms of trade. Quotation is applicable to a particular transaction only. The supplier will send it to show the price to be charged, terms of payment, and period of delivery. It is usually sent as a reply to an inquiry. Order. An order is a statement sent by the buyer to the seller, stating the full description and quantity of goods required. After the buyer has gone through the catalog, he will then place an order. The order will show the goods required, the quantity, type, conditions of payment, purchases, and method of delivery. The invoice. An invoice is a commercial document used in business transaction, giving a complete or comprehensive summary of a transaction involving sales or purchase of goods. Most invoice bears the term E and OE, that is, errors and omissions expected. It is sent by the seller to the buyer to provide him the following information, which includes the list of goods bought and their description, the quantity of each purchase and price, the charges for packing, the means of transport, terms of delivery and payment, the total amount expected from buyer after discount, the discount granted, the name and address of suppliers. An invoice is used to show the details of goods sold. It also serves as a receipt. It is used to write up the purchases or sales journals. The delivery note. The delivery note is a document which usually accompanies the delivery of goods. It provides the buyer with a list of items in a particular consignment. It enables the goods to be checked by the buyer and to ensure that they are delivered in good condition, especially when goods are delivered through the seller's means of transportation. A delivery note is used to confirm the goods on arrival before it is filed for reference. A delivery note is used as evidence of delivery. A delivery note is used when goods are transported by the wholesaler's means of transport. We also have the advice note. The advice note is a document sent by the supplier to the buyer, informing him of the date in which the listed goods were dispatched and the means of transportation employed. It is normally sent to reach the purchaser ahead of the goods which are sent through the rail. Advice note will provide information on when and where to expect the goods sent. An advice note is used to inform the buyer that his goods are on the way. It is used to show the mode of transport used. It is also used to inform the consignee of the likely time the goods will arrive. The consignment note. The consignment note is a document supplied to a carrier when goods are to be sent from one place to another. The consignment note gives details of the goods, number of packages, weight, name and address of the sender and consignee. The document, after being completed by the sender, is handed over to the carrier and signed by the consignee on the delivery of the goods, therefore providing proof of delivery. The consignment note is used when the wholesaler engages an independent transporter to convey the goods to the retailer. It is also used to show details of the goods sent. It is used as an evidence of delivery when duly signed by consignee. The credit note. The credit note is a document sent by the seller to the buyer to correct an overcharge. The credit note arises because some goods which had been charged were returned as damaged or not as ordered. Therefore, the credit note is sent to a customer for reduction in the amount owed him. To avoid confusion, it is usually printed in red. The credit note, as we've said, is sent by the seller to correct an overcharge on an invoice. It is sent when the buyer has returned some faulty goods to the seller. It is also sent when the seller has decided to give an allowance to the buyer. Now the debit note. The debit note is a document sent by the seller to the buyer to correct an undercharge or when goods are not charged on the invoice. It is also referred to as supplementary invoice. A debit note is sent to the customer to increase the amount of charges on the invoice, therefore increasing his indebtedness. A debit note is used to correct an undercharge. It is used when the invoice is not well priced. It is also used when some items dispatched have not been documented in the original invoice. It is also used to inform the buyer that his account has been debited. The statement of account. Statement of account is a document sent by the seller to the buyer at regular intervals to him of all transactions made during a particular period and the amount due. The statement of account usually shows credits and debits to the account and the balance due. The statement of account enables the customer of a firm to have a thorough check of what he has purchased. It also gives the customer an idea as to his financial standing at a given period. The information in a statement of account is used by bank customers to prepare a bank reconciliation statement. The customer can use the statement of account to check the accuracy of the entries. The statement of account shows the balance due for payment. The statement of account shows the amount of goods bought and payment made. The statement of account draws attention to accounts which are overdue. The statement of account is a request to pay. Now the pro forma invoice. A pro forma invoice is an invoice that is usually submitted before goods are dispatched as a polite request for payment to be made in advance when a seller is not willing to sell on credit and to show the goods. If the goods are retained, it becomes an ordinary invoice. A pro forma invoice is used to serve as a quotation. It is used when goods are sent on approval to a customer. A pro forma invoice is used as a reply to inquiry. It is used when dealing with a customer for the first time as a polite way of refusing credit. A pro forma invoice states the term of sale. It is also used when goods are sent to an agent to be sold. A pro forma invoice is used in foreign trade when goods are exported on consignment, stating the price of goods. Differences between ordinary invoice and pro forma invoice are as follows. The ordinary invoice is used as an evidence of credit sale, while pro forma is used when the seller does not want to sell on credit. Ordinary invoice is always sent with the goods, while pro forma invoice can be sent without the goods. Ordinary invoice is not used to provide information but to confirm sales, while the pro forma invoice can be used when the buyer needs information from the seller on terms of sales. The receipt. Receipt is a document which acknowledges that payment has been received from the buyer. When the customer receives the goods and he sends the money to the seller, who in turn issues the receipt as evidence of payment. Receipts must be written and signed by the seller and sent to the buyer, stating the actual amount received. A receipt is used to serve as an evidence of payment. It states the actual amount received and who received it. A receipt shows the date of payment, and a receipt is used for auditing purposes. Trade terms and abbreviations. Trade terms are the various terms and abbreviations commonly used in commerce. They are discount. A discount can be defined as a reduction in the price of goods to encourage bulk purchases and prompt payment. A discount decreases the amount someone pays when buying goods. Types of discount. We have the cash discount, the seasonal discount, the quantity discount, the trade discount. Cash discount is an allowance given to a customer to encourage payment for goods and services within a stipulated period of time. It is a reduction given by a creditor to his customer on an account paid before a specified date to ensure prompt payment. The seasonal discount is a price reduction given by a producer to a buyer who is willing to order, receive, and pay for goods during the off-season or in advance of selling season. For example, a retailer will be granted a seasonal discount on Christmas goods. Quantity discount is offered by the supplier to retailers as an inducement to buy large quantities of goods in a single order. Large order quantities can help to reduce the supplier's selling, handling, transportation, and inventory cost. Quantity discount represents an additional way to reduce the price of goods. Trade discount. Trade discount is a basic discount given to a middleman as an inducement or rebate for performing certain functions in the channel of distribution and to cover his operating costs and profit. Trade discount is also referred to as functional discount. It is a deduction in the standard price or catalog price of goods on sale to provide for the retailer's gross profit margin. Trade discount is based on a quoted retail price. Terms of sale. We have the cash sale and we have the credit sale. Cash sale involves the transfer of property or goods from the seller to the buyer on cash basis. Cash will be paid immediately for goods sold to customers. Types of cash sales include the prompt cash, the spot cash, the cash with order, that is CWO, the cash on delivery, that is the COD. Prompt cash is a term of payment in which the buyer is expected to pay for the goods purchased within a few days. Spot cash is a term of payment in which the buyer pays cash immediately for goods bought before he takes them away. Cash with order. Under this system, the buyer must enclose the money when the order is placed. If the money is not included, the contract will not be honored. This is common in mail order business. Cash on delivery is a term of payment in which the purchaser is expected to pay for the goods through the postmaster immediately they are delivered to him. This is a service provided by the post office and is common in mail order business. Credit sale. Credit sale occurs when ownership and possession is transferred to the buyer by the seller without immediate payment.